Hi, Wade.
How you doing?
Good. It's
Hey,
good to see
Wade.
you.
Well, good to see you again.
Yep, we don't know each other very much, Wade, but I see your name all the time.
Well, we'll have to meet sometime.
I hope we do.
Me too.
So we're not quite there on YouTube. I gotta figure some more stuff out, but got us recording. So here we go.
Okay.
Well, Wade, did I tell you the good news about 3990?
No, what's going on?
Oh, we're gonna be talking about it today. I'm gonna let the suspense build,
That's cruel.
but it's good news, so you'll love it.
It is
That's-
good news, Wade.
That's
All
good.
good.
Excellent.
Dave White's here. Dave, how's it going, my friend? How you been? And Paula's here.
Good. Sorry, I was muted.
No, you're good. You're good, my man. How you been?
I'm all right.
Good. Glad to hear it. Kicking butt on those flips you got going on.
I don't know about kicking butt, but
Yeah.
surviving.
Spanking butt, I don't know. Moving in the right direction, I hope.
Yeah.
I love it. Well, good. Paolo, welcome. Good to see you here. We got some good news. We'll go ahead and get started. I know people like to trickle in kind of throughout the hour, so we'll go ahead and get rolling here. Wade, our 3990 project. We spent a lot of time talking about that last week, and
Yeah.
how a little bit of a disaster. I mean, we did the right things. We structured it right. We did all the right things to make sure that we protected ourselves, and it did protect us. It shielded us against the worst that could have happened, which was
Right.
us losing money. So we ended up listing that on Thursday, and by the end of Saturday,
For
we had
$849,000.
huh?
For $849,000.
Yeah, we
Okay.
listed it for 840 on Thursday, and by Saturday, Maley had like a dozen offers, and
Wow.
we ended up accepting one for 880,000
Whoa.
with a $20,000 appraisal guarantee. $20,000 appraisal guarantee. So that means as long as it appraises for 860 or more, which it will, right? We always list our properties, and we'll talk about this strategy here in a second. We always list the properties low, but as long as it appraises above 860, they will pay us 880. So
Excellent.
they'll make up the difference in cash. So that puts us roughly at about $80,000 in profit on this property.
Sweet.
Not bad.
Sweet.
Yep. It'll be split up among the partners. So well done on this one. Way to stay patient with it. Way to stick it through the end. And we ended up making some extra money because of it. So,
Excellent.
and that's a great example of kind of the moral of the story from last week. And that was time heals all in real estate. So you just got to make sure you set yourself up so that you can hold it long-term if you need to, especially in something short-term like a flip. In this one, we set ourselves up so that we had the ability to hold it long-term. We ended up needing to on this one. And it worked out for the best because we've seen a ton of market appreciation over the last 2 years that we've held this property. Our ARV ended up going up because of that when we listed it, and then we did list it conservative and got an amazing offer on it, and we're going to end up catching out beginning of March. So I believe March 10th is our settlement deadline on that one. Is that correct, Tyson? Somewhere in that
March
area.
13th.
March 13th.
I'm
Okay.
so sorry. March 12th, because March 11th is my birthday. And I thought, man, if this was my house, it'll be a good birthday present.
Right. Yeah. Well, happy birthday, Tyson. We'll celebrate for you.
Sounds good to me.
So we'll be watching for that, Wade. I'll connect with you, and we can make it happen when we close. Now, I want to talk about listing properties for just a second. So this one happened to sit it sat on the market for a really long time. Not this most recent time that we listed it, but when we first, it took us 6-8 months to do the construction project, and then we listed it and it just kind of sat. Right, we listed it with a different agent, just kind of sat, and then went back and tried, we, in the interim, we Airbnb'd it for a while. We rented it out for a while. And then we tried listing it again about a year ago. Again, it sat, right? Couple of things that I think this time around made all the difference, because Maylee, we had it under contract within 2 days of Maylee listing it. And she's really developed an amazing system. I mean, we saw it on this one. We saw it on the 2700 project that we did together. A couple of things that she does that I wanted to share with you guys today, and then we'll kind of open it up, do a question and answer session. When you're listing flips, really the first thing that really knocked it out of the park for us was staging. We had it, we had our Airbnb stuff in there, and when you're buying furniture for an Airbnb, you want it to be nice, but you're also not going to go spend $1 million on furniture, right? So a staging company kind of offers the best of both worlds, where we can rent really expensive furniture for a fraction of what it would cost to buy that furniture, right? So we ended up hiring Shelley. She was on our webinar last week, and she did an amazing job, put really high-end furniture on there, just really knocked it out of the park when it came to staging. And staging is something that helps people visualize what can be done with the space. There are a few funky spaces in that house, right? But Shelley did a great job of staging and showing what could be done potentially with that space. And I think that really helped drive intrigue. The other thing that we really had going for us was, people, we tend to get, for lack of a better word, greedy, right? When we go to list a house, we're like, okay, our ARV's 890, right? So we want to list it for 900 and try to push value on this thing. Well, it has the opposite effect on people. People are going to look at it and be like, oh, this thing's only worth, 890 or maybe 880 in their opinion. And they've listed it for 900. We're not going to waste our time, right? We're not even going to make an offer. So all of a sudden you've got this reverse psychology going on where people are, people are kind of turned off by you listing the price or listing the house aggressively. So what we've done is now we've started to list every property $10,000 to $20,000 low. So in this case, we saw our ARV at 860, and we're like, you know what? Let's list it at 849 and see what happens. Because we listed it low, because of the market climate right now, it drove a ton of offers. We got offers ranging from listing price. There were no offers below listing price, but ranging from listing price all the way up to the offer that we ended up accepting of $880,000. So I think those two things in combination are really good secrets. So when you get done with a flip, finishing the construction project isn't the finish line. You have to sell that thing, right? You got to cash your check at the end of the day. And so, you put all this blood, sweat, and tears into doing a project. You want to list it for top dollar. I get that, right? But there's a saying that I was taught very early on when I first started learning real estate investing. One of my mentors, his mantra was, remember that pigs get fat and hogs get slaughtered. That was John O'Neill that said that. Pigs get fat, hogs get slaughtered, right? It's okay to want to make money. That's definitely fine. But as far as, if you get too greedy and you end up listing a high, it's just going to sit there, right? So that's where this strategy comes in. If we list it $10,000 to $20,000 low, we're going to knock it out of the park. Now, I want to open it up to some question and answer. So if you guys have questions here, let's go ahead and open that up. I know I had a student that had a question. I told him to save it for the webinar. Tyson, do we have Evan Anderson on the call?
Who?
Evan Anderson.
I don't see Evan Anderson.
Okay, I'll reach out to him. In the meantime, let's open it up to what you guys are working on. If you've got projects that you're working on that you want to talk about, get some advice on, get a second opinion, get, the 13 other opinions is how many people we got on the call right now. Bring it to the table. Let's talk about it. Let me know what you guys have going on, and let's dive in and talk about it. No takers, huh? Well, let's get Evan on the call. I know he had a deal he wanted to walk through, and I asked him to save it for the call here. So I've reached out to him. We can walk through that. Now, with that said, while we're waiting for Evan to get on, I just texted him the link. While we're waiting for Evan to get on, we'll walk through his property that he has going on. Just a quick reminder, Maylee and I have started 2 YouTube channels that we're hosting a ton of content. And the main goal of that content is to provide value to you guys, right? So we've got our Flippin' Sexy Real Estate, which is our before and afters of our fix and flips. We walk through the very beginning stages and every step along the way, all the way to finishing it and selling it. And we show, what it looked like at the beginning, the process to get it, to make it beautiful. And then, some of the stuff that we've even talked about today, and the strategies that we use to go out and list these properties and sell them for top dollar. So that is youtube.com/flippinsexyrealestate. And then we've got our second channel, which is the Flippin' Sexy Real Estate Education channel. So that one doesn't have a unique link yet. We don't have enough subscribers yet to get there, but we will shortly. With your support, click subscribe. It's free. Just do it because you're going to want to know when new education comes out. We have put all of the boring stuff, all the classes that go over these strategies in great detail. We've put on the Flippin' Sexy Real Estate Education channel. And that is where we're going to continue to update, on an ongoing basis. We're going to continue to update that channel with new content, new classes, etc. So, Tyson, I'm getting a text back from Evan here with, he's asking for the password. Do you know what that is?
Oh,
Can you just text it to me?
it's interesting that it's requiring him for a password. Did all of you need to put in the password as well?
No.
Usually the link includes the password.
Yeah,
No.
Do you have that link?
I do have the link.
Actually, I've got it right here. I can do that. Tyson, I'm curious to hear what you thought about the 3990 project and kind of how that listing process went since we chatted last week. What are your thoughts?
I will share my experience with 3990 as far as listing and selling goes. The first time it was listed is when I started. Is right when I came into the picture with Mitch. I started working with him very closely about the time that it was listed, that first time. And they used a particular realtor that was exclusively his listing, I guess you would say. And the market wasn't as hot when he started showing the property to people, but still properties were selling within about a month back then, right, Mitch?
Yep.
Yeah. And so I don't understand why he wasn't able to sell it. And really, I don't, because it's a beautiful house.
I have an answer for that though. Let me just interject there real quick. Don't forget what you were going to say.
Okay.
So do I.
What I've found, what's that?
I said,
Was
so do I. You say what you think, and then I'll tell you too what I think.
Yeah, Sheri.
I'm interested in your opinion too, Sheri. Sheri's a broker. So, and I'm going to be talking about agents for a second. What I have found is that agents have a certain skill set. Now, this particular person that we let list this house, he's amazing at finding properties. I think I bought more properties from this one agent than I have any other agent, with the exception of Maylee. So, he's an amazing buyer's agent, and that's where his skill set lies right now. Maylee, in contrast, is a fantastic listing agent. I mean, she's got skills and knowledge and things just come naturally to her that lends her to being somebody who can list a property and sell it. Right. But maybe not as much on the buyer side. So, especially if you're an agent, or even as investors, if we're going to use agents, identify whether you're working with someone who is a better buyer's agent or a better seller's agent, and then put those aces in their places, right? If you're working with someone that you have recognized is a buyer's agent, get them out finding properties for you and use them on the front end, right? And then find somebody who's an amazing listing agent, and they're usually not the same person, and get that person selling your house for you on the back end, right? It's going to do a lot better for you. And it serves well if you're an agent, you have a license to do some discovery and figure out which one you're better at. Are you a better buyer's agent? Are you a better seller's agent? And then market yourself as that. You're going to make a whole lot more money focusing on what you're good at than trying to be a jack of all trades. Now, Sheri, I'm interested to hear your opinion on that.
I'll finish first because Sheri, I want to hear your perspective on this.
Go ahead. Yeah.
Yeah. So this time around, we had the stager. Just like Mitch said, the stager went in and she did a fantastic job. In fact, if you guys want to look, 1768 East 3990 South, Holladay, Utah. If you want to look this up on Redfin or your local real estate website, go ahead and look at the pictures while we're talking, because she did such a good job. And also, while she was there, like I said last week on the call, Shelly, the stager, is so particular about all the details. So and that lends to her favor and our favor, because she's able to see what is wrong with the property. She sees stuff like, ooh, that's not going to show very well. Tyson, would you mind changing it this way, or cleaning it up, or fixing it, or adding this thing? Because I think it'll show a lot better. And because she is an agent herself, by the way, she has clients and she helps people buy properties, so she knows what people look for and what they don't look for. So I put in a lot of work to I guess, the property is not perfect, no property is, but to get the property close to perfect. And she did a lot of work to get her into the property staging close to perfect. And that combination, add Maylee, who's a good listing agent. She was very strategic on the day that she listed it. She had an open house. She met lots of agents who are high-end buying agents, and that's going to help us in the future. But the combination of those things were all different from how it was the first time it was listed. I think that's from my perspective what made the difference this time.
Yep, I think you're right. Maylee's really good at that. And I don't know if everybody knows who I am. I kind of help Maylee with the paperwork in the back end, and Mitch and Maylee and I, we all kind of strategize and do some things. We talk about a lot of things on how to present. But one of the things on this listing that I thought was interesting is the initial agent. I think he leaned on his brand. He said, I'm with this high-end real estate and that is going to sell this house. Well, that's not what happened. The two photos that were used for the initial photo, they're identical. And then the only thing that changed was the photos that we used afterwards. So he had different photos than what we had with the stager. They had a really good photographer. I was careful about how I organized them. I kind of like to make you feel like you're walking through the house as you look at the photos.
Like, tell a story with the photos, right, Sheri?
Exactly. And I think that made a big difference. We also kind of didn't let anybody see the house until the two open houses. So it was kind of like, well, you can't see it yet. We're not going to let you, but you can come during the open house. And so there was a lot of buzz. There were a lot of people walking through. And I think that kind of created additional excitement, because essentially you guys fixed and flipped and made a beautiful house, but not a whole lot changed from listing 1 to listing 2, except presentation and then the staging. So that's
Absolutely.
my 2 cents.
I agree 100%. And that's key, right? And I mean, I'll be the first to admit, since Maylee and I started working together about 3 years ago, my business has changed for the better. Just because I've got another skill set, right?
Yeah,
I mean, now these properties have a woman's touch, and that's something that they were missing before. Because I don't have that design eye that Maylee has for things like presentation and listing and staging and all those things that make her a great listing agent. I just thought, hey, we'll make this thing look pretty with a hammer and a paintbrush, and then we'll throw it back on the market, right? So there's that extra stuff that we gotta pay attention to. So I love it. That's great feedback. For those of you who are joining us, we were just talking about that house that we toured last week. Last week we talked about all the problems that we faced in that 3990 property. We ended up listing it on Thursday for $849,000. On Saturday, we accepted one of many, many offers that we received, $880,000 with a $20,000 appraisal guarantee. That, you can't get better than that, my friends. I mean, it's about as awesome as it gets. So All right, well, let's open it back up. I saw a couple of questions in the chat here. So Charlotte asked if we see the market slowing down at all. You know, your crystal ball is just as fuzzy as mine. Anything can happen, right? I mean, a lot of it depends on what the Fed decides to do with interest rates. You know, you may see lending start to tighten up a little bit. I know here in Utah, we have an inventory problem. Not very many people are selling their houses because they're appreciating like crazy and they're enjoying, you know, picking up on all this equity. So, you know, anything can happen. But here's what it comes down to. And this is, you know, back to this 3990 property that we've been talking about last, this week and last week. You know, terrible things can happen. The market can change, the bottom can fall out, and you lose 100 grand worth of value on your flip. You know, contractors can rip you off. Agents can do a bad job. Whatever the case might be, all sorts of stuff can go wrong. What really matters is that you have structured the deal right so that you can hold it in that eventuality. We know historically, we got 200 years of data, and you know, real estate investing goes way further back in time beyond that. But in the last 200 years of data, we can look and say, hey, look, real estate on average has increased by 3.5% a year. So we know even if we have this little blip where the market drops, it's going to come back and appreciate even further beyond what it was when it dropped. So being able to hold it long term and having that as your backup plan is key, right? So I talk about this a lot actually in the using other people's money class. So on our Flippin' Sexy Real Estate Education channel, it's organized by playlist. You can go into the playlist that's called Using Other People's Money, or and there's a whole module on what I call the debt equity blend. It's a great way to acquire properties. It keeps you safe, and it allows you to you know, to protect yourself against these eventualities that we've been talking about. So hopefully that answers your question, Charlotte. I wish I could just give you a straight yes or no. I hope it keeps doing what it's doing because I'm really enjoying it, but it's not going to forever. At some point, it's going to change. That could be tomorrow. That could be next year. I don't know. I'm sorry.
But Charlotte, I can answer your question from what we're experiencing here in Utah currently. The market is not slowing down currently. That's for sure.
Not from what we can see.
Yeah.
But we can only see about 10 feet in front of us when it comes to that stuff. So
yeah, so it's important to not bank on that, right? To not plan on that happening next time we get a flip. We got to plan on other things just like you said, the debt equity blend is very important.
Yep, absolutely. Keeps us safe. And this property that we've been talking about last week and this week that Wade was in on, perfect example, right? Keeps us safe. All the bad things happen. It's okay. We still made money. Took us 2 years.
Charlotte has a second question too, Mitch. How many offers did you get? I didn't count that up actually.
There were, I want to say 12. We'll have to ask Maylene. She's not here right now, but I want to say there were 12 offers that we accepted, or excuse me, that we received. And we did. So one of the things, if you know it's going to be hot, like in a market climate like this, where, you know, we did a beautiful staging job, we listed it low, all designed to drive multiple offers. Here's the thing. Every real estate purchase contract, every offer that's made, they give you a time frame. So the person that makes the offer, the buyer, the potential buyer, gives you a time frame that you can accept offers in, right? On a deal like this, we told people when they said, hey, I'm sending over an offer, we tell them up front, we're not accepting any offers until Monday morning, right? So that means that they've got to give us until Monday morning to get back to them. Why would we do that? Why would we say on Thursday when someone wants to make an offer, we're not accepting any offers? You can submit the offer, but we're not going to pick one until Monday morning. Why would we do that?
Anybody can answer.
Well, I could answer, but I'm cheating because I already know the answer.
Because you're part of the team that's making the offers with us, Sheri.
Enlighten us, Sheri. What do you think?
I think the strategy is you don't want to quickly accept that first offer because there might be another offer that comes in and it's higher than the previous offer. And then you're looking at the two offers going, wow, if I would have just waited, I'd have this higher offer. It also kind of lets at least from the agent side, it lets people know, okay, you
Be
already know
competitive.
you're going to get multiple offers and you want to look at all of them. So I better give you the best, highest terms, conditions. Maybe I can pay over the appraisal, whatever it is I can do to make my offer stand out. And they're all going to try and give you the best offer the first time instead of haggling back and forth.
Exactly. Yeah. And you know what? Inevitably, that first offer is usually the worst one, right? The first offer we got was asking price. And then we just taken that immediately. We couldn't have accepted any other offers because we would already be in a contract with that first offer. So at that point, we're kind of sunk, right? So we want to give ourselves some time, and we let people know, hey, we need 3-4 days for acceptance here. We'll get back to you. We'll let you know, but we need 3 or 4 days. We can wait for other offers to come in. And then as those other offers start coming in, we can call back the first few people and be like, we got some more offers. If you guys want to stay in the game, you're going to have to get more competitive than this. And they may send, an adjusted offer. They may not, right? Some do, some don't. But then it starts driving it up, right? And that strategy is how we got $30,000 above asking price on this property. We create competition by the way we behave, right? We like Sheri said, beautiful presentation, we do all the right things in the listing, and then when it comes time to receiving offers, we create that competition that inflates the price, which benefits us.
And let me tell you also, the agent who submitted the offer that they ended up choosing, his email made it very clear that he is here to play ball. I'm not sure if maybe showed you that email, Mitch, but he's like, my client is extremely serious about this property. This is the one. We prepared an offer that's very favorable for you guys. And if there's anything that's going to make us not win, let me know before you make a decision, because we're going to up it. We're going to change. We're going to do whatever it takes to get this property. And so, yeah. And I'm also looking at this real estate purchase contract for the offer that you guys chose. And did Maylee tell you, Mitch, that they're paying $171,000 in cash?
Yeah, $171,000 down. I think they got it from the proceeds of a sale, from the sale of their house, right, that they're moving out of.
Yeah.
So yeah, it's a very strong offer.
Yeah, the key
30-day
there is
close.
that you have a strong buyer because they have a decent down payment. So the chances of their financing falling through are pretty slim. Not that it's not ever going to happen. The other strategy we all talked about, Mitch, me, and Maylee, was having some backup offers, because guess what? People still cancel. And so then that backup offer can just slide right into place, take over. You didn't miss a beat. You didn't put it back on the market.
It's true. Absolutely. We have, and I believe, correct me if I'm wrong here, Sheri, but we can do multiple backup positions, right? It doesn't have to just be one.
Right.
We can have 2, 3, 4, 5 backup positions, and you just let them know, hey, you're in first backup, second backup, third backup, and they just get in line, right? And in a market climate like this, where we have, 10, 20, 30 times the number of buyers than we have inventory, which is the number of listings on the market, people will wait in line, right? Because there's nothing else out there. So they'll wait in line. So if ours happen to fall out.
Oh, sorry.
No, I was just gonna say, if the deal that we accepted in primary position ends up falling out, we got all these backups.
Yeah. And then for you guys in your market, it does behoove you to work with an agent that's experienced, because what you want to get from them is something that I look at almost daily. How many listings came on the market today, and how many of those went under contract? So the other day we had 881 listings. By the end of the day, 224 were already under contract. That was one day. So that's something for you to gauge your own market with. If you've got a situation like that, you're in a hot market. If it's a little slower, then you just need to strategize. But that kind of answers the question, what's my market going to do?
Yeah. Yeah. And in a slower market, we're kind of playing the opposite, right? We don't have that leverage anymore. As in a market like this, as the seller, I have all the leverage, right? Basically, I can get whatever I ask for. But in a buyer's market, when things are a little slower, I lose some leverage. So I've got to do some other things. I've got to be a little more you know, a little more bearish about how I approach the listing and the sale. You know, understanding that I may list it for one price and then get an offer that's maybe $10,000 below that. So we change our strategy a little bit. We don't want to go too far below asking price. You still want to be a little bit below because that's going to drive attention, right? People are seeing a great deal. You're going to get attraction. And even in a buyer's market, potentially you could still get multiple offers. But you also want to be aware that you might only get one offer. So don't market 30 grand below what you should be marketing it at. Maybe go 5 below or 10 below, right?
So the question I have for you, Mitch, is when this buyer can come in with a cash portion of their offer that's larger than normal, does that sway you? How does that sway your decision?
Well, like Sheri said, it informs me on what the bank's going to be doing. So one of the concerns, if we accept an offer, we've got 30 days for the bank to make a decision as to whether or not they're going to lend that person the money, right? And I'm just sitting on my hands. I got holding costs that are piling up, and we're just praying that the bank says yes. When someone comes in with a very low amount down, that means the bank has to take a higher amount of risk on the property, which lowers my confidence in that buyer, right? But when someone comes in with a huge chunk, right, they're coming in with 200 grand down on this property, then the bank is taking less of a risk. They factor that into their approval. If they're looking at a situation saying, hey, this guy's coming in with 30% down, you know, we're going to have $300,000 worth of equity in this property. You know, the bank's going to jump on that faster than they'll jump on someone bringing the minimum down. So it makes them a better borrower too, which the bank's part of my ability to sell this property, or any property for that matter, if the buyer needs financing. So you want to kind of pay attention to those indicators that inform you as to whether this is going to be a strong borrower as well, if they need financing for the property, if that makes sense.
Yeah. So what I'm hearing is that if they come in with a larger cash portion of their purchase money, that means that they're kind of doing a debt equity blend, and they're a safer person to lend to.
Yep, absolutely. Yep, it makes me more excited to take their offer because it means less chance that the bank's going to ruin it, right?
Hey, Mitch.
Yeah.
Coach Dan, what's going on? Good to see you, my friend.
Good to see you. Hey, backing up to what Tyson was saying about these people that were making the offer, one contingency I like to put in the purchase contract is it says buyer will pay, and then I've got a blank for X amount of dollars. So we could put in there, buyer will pay whatever, $1,000 over any other verifiable offer within reason. And so ultimately, as the buyer, what you're doing, it's kind of like what Tyson said, where that agent said, look, my buyers are all over this, and if you get another offer, you let us know, you know, kind of thing. And in a situation as investors, if we have a clause like this in our offer, then we're kind of dangling the carrot in front of the seller and saying, look, if you get an offer, I'll beat it by 1,000, or I'll beat it by 2,000, whatever dollar amount we want to put in there. And you're just trying to, incentivize the seller to communicate with you so you can decide whether you want to play ball and go higher or not. If they came back, if our offer was 220 and the max we could go was 225,000, and they come back and said, hey, we got another offer at 221, does that mean you're going to pay 222? We'd say yes, and we'd take the deal, right? But
Right.
If they come back and they say, hey, we got another offer at 226, and that's over our max, does that mean you're going to pay 227? We can say, no, that's not reasonable for us. Go ahead and take that other offer, right?
Yeah.
And then the other part of that clause is I put verifiable offer, because the other thing we don't want the seller to do is claim they got a higher offer and they're running up the money scale on us. We want to say, well, let me just double check and verify you got another legit offer. So anyway, just a thought.
Yeah. No, that's absolutely. So that's I refer to that as an escalation clause.
Correct.
So I use that as a tool, right? Like you said, when you're a buyer as an investor, I think it's a smart move, because if you're coming in and saying, look, I'd pay 245 for this property. It's listed at 200, but I'm not going to overpay. Right. So you can come in and you can say, hey, my offer is 200,000. But with an escalation clause that I will beat any other verifiable offer, which means they've got to show me the offer for me to verify that it's real. Right. Beat it, like you said, Dan, for $1,000, whatever your highest offer is, I'll beat it up to 245. Right. That way I'm not overpaying. I'm protecting myself there. I hate to leave 45 grand on the table. But also it makes me competitive. So I think that's a very smart advantage. We didn't get an escalation clause. Now, from a seller's perspective, we didn't get an escalation clause on this property that we've been talking about the last couple of weeks, but we did on a property we sold recently. In fact, we have a really cool before and after of this property on 2700 East. Wade was involved in that one as well. But we did end up receiving an escalation clause and ended up, I think it was the one that we accepted. Don't quote me on that, but I'm pretty sure it was, that ended up being an escalation clause to where, their cap was, above and beyond what any other offer we got. It drove it all the way to, I think that one we sold for 570, 575, something like that. It's in the video. So check it out. I put it in the chat box here. But you guys can see the process on that one. So Tim Quinney said, why not require a lender letter to accept the offer? That's a really good thought, Tim. It is something that we require. So it's called a pre-qualification letter. Now that doesn't mean that they're qualified and that it's being underwritten. What it means is the bank has verified that their credit's in order, that that their income is there, and usually a pre-qualification letter will state an amount as a maximum, or the kind of that high mark that they'll lend them. So if someone, in the case of this property, the first thing that Maylee asks when someone says, hey, I'm sending in an offer, she says, great, send me over your pre-qualification letter, right? And then if the pre-qual letter says that they'll only qualify up to 600,000 on an $850,000 house, we're not going to accept that offer, right? Because we know it's going to get destroyed in financing. So we're looking for something that's 900, $1 million, something like that in this case. But yes, that's a good call, Tim, because that is something that keeps us safe. It's part of our vetting our buyers to make sure that we're accepting the right offer. Because the last thing we want to do is for this to go 30 days and then they have to back out because they can't get financing, and then we have to go back on market with our tail between our legs, like, here we are again, right? Let's try it. You lose a lot of leverage when you're going back out the second time. So we don't want to do that. That's a good call. So quick announcement before we go to the next question. Wanted to let you guys know I have started uploading all of these Ask Mitch Anything videos to the Flippin' Sexy Real Estate Education channel. Flippin' Sexy Real Estate Education. So these are all available. It's in a playlist called Ask Mitch Anything. I have from last week all the way back to about October of 2020. I have videos from before then that I'm continuing to upload. This one should be up, up on the YouTube channel within 24 hours is my goal. So you guys can go back and review those things and check them out. And, it's good information to be able to refer back to, right? So, all right, let's open it back up for questions. Who else has questions? I see Evan's here. Evan, do you want to tackle your question right away?
Yeah, sure. Can you guys hear me?
Yeah,
Yes, sir.
Oh, perfect.
How you doing, bud? Good to see you.
So right now, I'm in Las Vegas, and there is a house that is a foreclosure that just came up on the market probably within a week. And it's a big house. And it's definitely a house that's like, it just costs a lot more.
Two questions real quick before you get too far. Do you have it under contract yet?
No, I've only seen pictures of it. I haven't, I've just ran some basic numbers on it, nothing crazy
You
yet.
sent me the link for it, so I was going
Uh-huh.
to share my screen. But if you don't have it under contract, I don't want anybody out to go out and steal it out. I doubt anybody on this call would, but it's going on YouTube too. So we'll just chat about it. So go ahead with your question. Sorry about that.
Yeah, no problem. So mainly, I'm just trying to figure out what we can do to make the money that we need to just acquire the house and get the deal done. That's really all it is.
So in regards to raising the money, is that what you're asking about, or like more like running the numbers and figuring it out?
Raising the money would be good. Yeah.
Yeah, absolutely. So, I mean, pretty much as a kind of a blanket rule, there's always exceptions to every rule, right? But as a blanket rule, I like to stick to the debt equity blend for all the reasons that we've been talking about over the last 2 weeks, right? It's just going to protect you in the long run if anything changes in the market, if anything happens during that remodel process that causes you to spend more money or that changes the value of the property. A debt equity blend is going to give you an equity position that will allow you to go, get long-term financing if you have to, even if that means bringing in a credit partner, right? So what the rule is. Now, let me say that we're going to do kind of just a quick run through of the debt equity blend. This class is available on the Flip and Sexy Real Estate Education channel under the using other people's money class. So you're going to want to check that out, review that. I believe it's 10 modules long, so about a 3-4 hour class. So just quick overview here. Debt equity blend. When we're acquiring a property using debt equity blend, a lot of uneducated investors will go out and they'll use all debt, right? So let's say you've got a house that you're going to buy for $250. You're going to put 50 grand into fixing it up. So you need $300,000 to make this happen, right? The uneducated investor will go out and they'll borrow as debt 300 grand. And then they'll go do this deal. Well, 7 times out of 10, you're just fine. You do the deal, you make your money, etc. Right? But what about those other 3 times? What happens if you end up spending more? What happens, heaven forbid, if the next 2008 happens? Back to Charlotte's question, when's the market going to change? I don't know. Could be tomorrow, right? And you bought that house today and you put the money into it. You already borrowed the money and you thought you were going to be able to sell it for 400, but or you thought you were going to be able to sell it for 350, but it drops to 250 tomorrow because the market collapsed, right? Something catastrophic happened. You lose 100 grand worth of equity in that property. Now you're upside down. You borrowed 300 thinking you'd sell it for 350 and now it's only worth 250. What do you do? Well, if you've used hard money, that stuff's due in 6 months. And if you don't pay them back, guess what? They're going to foreclose on the house, right? You can't go refinance it into long-term because you borrowed 300 and the collateral is only worth 250. So no bank is going to give you a mortgage for $300,000 on a piece of real estate that's only worth $250,000. So my point being, you're sunk. This is why a lot of people lost money in 2008. This is why real estate investing has a bad name, and people think that it ruins lives. But it's because the people who went out and did it didn't do it very, very smart, right? So debt equity blend protects us against that. Debt equity blend says whatever the amount is you need to raise. So in this example, we said an acquisition of 250 and then 50,000 in, that's $300,000 we need to raise total. 2/3 of that will be debt. We can use hard money even, right? Our hard money lender, our 6-month guy, 200,000 of that will raise in hard money. The other third we raise in equity. So that means that Evan, you're going to go out and you're going to call your friend, Tim, and you're going to call your friend Tyson. You'll be like, hey guys, we got this deal. Can you guys scrounge up 100 grand between the two of you and let's go partner up and get it done? And they say, yeah, let's go do it. And then now you've got your 300 because you got your 200 from hard money. You got Tyson and Tim coming in with another 100. Let's go do this deal and get it done. We'll split it 3 ways, right? That kind of thing. So let's run through that same situation. So if the market collapses in that case, right, and you thought you were going to be able to sell it for 350, but the value drops overnight to 250, you've only borrowed 200. So you've got an equity position. The 3 of you can go out and get long-term financing on that $250,000 piece of real estate, get that long-term mortgage for 200 grand, make little tiny payments, turn it into a rental, wait out the market crash, wait till the market comes back. It may take a year, it may take 5 years, it may take 10 years, right? But you guys are making cash flow the whole way. And then the market comes back and it hits 350 again. You sell it, you all make what you were planning on plus the cash flow while you were waiting, right? So and that's exactly what happened. Different negative things happened in this 3990, but basically that's exactly what happened. And we were able to write it out and wait until we had the value back in it and sell it. So it just is going to put you in a good situation. So debt equity blend is the way to structure that. I would not structure it all debt.
Okay. That's great. Thank you.
Now, any follow-ups to that question? Do you need more specifics on that?
I don't think so. We've done a flip before, but we had the cash to do it, and it was a much more simple one. And it's just the fact that this house it's going to need probably at least $100,000 worth of renovations of work put into it, and the price tag on it is I think it was around like 662,000 is what they're asking for. Okay. But on the high end, they're selling at in between 875 and 900,000. So there's definitely some room there to possibly have, for potential for it to be a good one, or to be able to make some good money off of it. But yeah, it was just more so, what can I do to get the money for something for a project that's just quite a bit bigger?
Networking is a great way to pick up equity partners. I mean, I've seen on this call, I've seen people connect and then end up going and doing a deal together, right? So just making people aware. Now, there are a few, again, I just posted the link to the funding deals using other people's money class. So you guys all have access to that. You can click on that and go watch it. But one of the points that I bring up, as you're raising money, remember that you can't do it in a public forum, right? So what's happened is you just said, hey, I'm working on this deal. I got some questions on it. And, somebody in the background, Don Johnston might be thinking, hey, I got some money in my HELOC because I'm doing the speed banking thing. I want in on that deal Evan's doing. So he's going to private message you. You can't go out and in front of 2 or 5 or 20 people say, I'm raising money, who's in, right? Because you need a license for that, and that's an SEC violation. But you can have one-on-one conversations with those people. So in this example, if Don were to private message you and say, hey, I might be interested in that deal, let's chat, and you guys have a one-on-one phone conversation or belly to belly, and you figure out that, hey, it's a good fit for both of us, let's go make it happen. Those conversations need to be done one-on-one, if that makes sense. So forums like this are a great way to let people know what you're working on, and then they can reach out to you individually and make that happen. I would also, attend your RIA meetings. So I know Las Vegas has a very big RIA, Real Estate Investors Association. Attend those RIA meetings regularly for no other reason than mingle with like-minded people who might have some cash, right? You don't need one guy with 600 grand. You need 2 or 3 guys that have 100 grand in their 401k, right? Or and then a hard money lender, and you got your debt equity blend going. So does that help?
Yeah, that does. That's great. Thank you.
Okay.
I appreciate it.
Good. Anything else on that property you want to talk about?
I don't think so. The only thing that scares me, if something were to happen, like that crash that we were talking about, that is always possible. This house, I mean, it would be scary. Like, what happens if you can't rent it out, and you can't receive that cash flow, and something drops automatically, and you're not able to do that because not too many people want to pay. They don't want to rent out a $5,000, $6,000, $7,000 house a month.
Sure.
So what would you say to that, maybe?
I mean, Airbnb, we kind of had the same thing on this property we've been talking about, where,
Okay.
long-term rental just wasn't going to make sense. We were going to break even. So we put it on Airbnb, and we ended up making some money, until the city actually stopped us because they changed the rules for Airbnb in Holladay City. So we had to close that down. But look, in a perfect world, I would say that you've got all the strategies in the world. But in the real world, you may have to make 1 or 2 mortgage payments. So you want to make sure that you have that set aside just in case, right? Maybe I always overfund my properties. by, 5 or 10% just for the oops factor, right?
Mhm.
And then that money goes back to when we're done with the project, that money just goes back to the equity partners. But you always want to budget a little bit extra for the oops factor. In this case, that's what that money would be used for. But you want a solid plan going into it. It's not a, well, maybe we'll rent it out. Might not get it, right? You want to have comps in place for your rental comps in place for your plan B. And if your plan C is Airbnb, have your comps in place on that as well. And you get your comps from Airbnb. What are other properties like this renting for in Las Vegas right now per night, right? And we've got a whole class on Airbnb. We call it AirCashFlow management, where we talk about, how to pull those comps and how to relate them to your property. So always make sure that you run to the very end, that you run your analysis on your primary strategy, your secondary strategy, your tertiary strategy, and so that you know exactly what you're going to do if that needs to happen, right? And all that needs to be done before you purchase the property, because you may need to structure your primary strategy slightly different to make sure that your plan C is going to work, if that makes sense. Now, a couple of things that may help protect you if the market does change. One of the things that I love about real estate is it's what I call a non-compressible market. It's a non-compressible commodity. Businesses can go out of business. There is no demand anymore for a company that rents out VHS tapes. That's why Blockbuster Video went out of business. There's no demand for it anymore. They had all the supply in the world with zero demand, right? So that means they're gone. And anybody that owned Blockbuster stock, their stock's now worth zero,
Nothing.
nada. Real estate's never worth zero, ever. It's at least worth the land that it's built on, right? So that protects us against that eventuality. The other thing is, people need a place to live regardless of what the economy's doing, right? They need shelter. That is a basic human need. So what happens is we see that demand presence shift. It doesn't go away like Blockbuster Video, right? It just shifts. And so what happens is, in a really good market like this, people are going crazy buying because they're like, I could buy it today and tomorrow it's going to be worth $100 grand more, right? So people are going crazy buying properties. We're in a mortgage market right now. But if that were to shift and people are like, it doesn't make sense to buy anymore because I'll buy it today and it'll be worth 20 grand less tomorrow, people tend to rent. They still need shelter, they just tend to rent, right? So the example or the question that you asked is, I'm worried about this property. If I do need to shift, well, your demand is going to shift from people buying houses to people renting houses. And so you should have a little bit more security. In that case, it's actually going to work in your favor, with that being your plan B. Now, high-end house, maybe not a lot of people looking to rent, like you said.
Yeah.
How much did you say per month? 6,000-7,000 a month?
Probably, yeah.
Yes, because what, a
At
$1.5
least.
million house in Vegas? That's probably enormous.
Yeah, it's a little over 6,200 square feet.
Okay, yeah, cool.
So it would be a pretty big
Nice
clip.
house.
Yeah, it's very nice. Yeah,
For
it's-
sure. Yeah, so take that into account. It's always a higher risk with those higher end properties, regardless. I mean, your buyer's pool is much smaller than if you're flipping a $300,000 house or a $400,000 house, right? Average Joe can go out and qualify for a mortgage on a $400,000 house. It's a very select a group of people that can either pay cash or get financing for a $1.5 million house. Right. So take that into account. You've got an increased risk factor. So make sure that your plan B, which may not be to rent it out, might be to Airbnb it, right? Those types of houses do really well on Airbnb. And you don't have to rent out the whole house. You can rent out the top floor or the bottom floor. You can rent it out by room. You could do, all sorts of stuff. There's a lot of strategy there. In fact, I would even say, let me pull the link for this class here. I'm going to send you the AirCashFlow management class, so that you can go kind of review some of those. This is one of the longer classes. This is about 6 hours long. Watch it on 2x speed, and then it's 3 hours long, right? But there's your AirCashFlow management. So check out that class. Maybe pick and choose the modules that make sense to watch. But that's going to kind of solidify that plan B strategy for you, which I think is a great strategy for exactly what you're talking about.
Okay.
lines up with what Wade and I did on this property.
Perfect. Thank you.
You got it, dude. Absolutely.
I've got a question.
Yeah, absolutely. Who am I talking to?
This is Kathy McKenzie. My son Michael, who's, every time I send a message, it's to Michael. Anyway, he has a friend that came to us last week, and then today that he said he definitely wants to do this. He wants to go in partners with my son. My son just got a big bonus. He just re-enlisted in the Army and got a bonus, and he's got some cash. So he wants to partner with him, and Michael do the down payment and the closing costs, and use his friend's credit. Because I kept saying, how are you going to split? He says he's going to split it 50-50. I said, okay, well, then there's no ROI on your investment. He says, well, I was thinking if it's 10% of the value, then I get 10% of the equity, and then we split the rest 50-50. I said, okay, so what does he get for his credit? He says, well, he gets the other half. So is that considered a good deal?
Okay, let's walk back through this because I'm a little lost. So
Okay.
Your son has a credit partner that's coming in on the deal, and his agreement with the credit partner is 50-50. He'll use his credit. What's your son bringing to the table?
It's going to be the down payment and the closing costs, which is going to come out to about 10% total after everything. Because the guy's going to do an FHA.
Cash. Who's managing the project? Both of them?
Probably me.
Probably you. Okay.
Yeah.
What are you getting?
I'm mom. So
come on now, Kathy. This is business.
I know.
That's way too sweet. I would, like, if my kids came to me and were like, "Hey, I got to fix and flip," I'd be like, "Well, what percentage am I getting?" Right. So that's very sweet of you. Now, where does that 10% come in? So you said something about 10%.
It's 5% down, and we figured probably. I mean, he doesn't know. It's going to be probably about $4,000 in closing costs, and I think there's an upfront.
So it's the cash needed.
$14,000 on $140,000. Okay,
so it's the cash needed to come in. Okay,
right.
So that makes more sense. So he's bringing basically 15 grand to the table. That 15 grand. Keep in mind at the sale of the house, obviously we're closing out friend's credit, right? But we also got to close out son's investment. So he's bringing $15,000 to that partnership. He gets that $15,000 back before the profit is calculated.
Correct.
So let's say the total proceeds are $45,000.
Well, here's the thing. Well, they want to keep it. They want to keep it and rent it.
Okay.
So it's this kind of long term.
I mean, eventually, if they sell it, he still gets his 15 grand back, right? Before profits calculated. If they want to keep it and rent it, then 50-50. That makes more sense. I was going to say on a fix and flip, that's awful generous for a credit partner, but someone that's going to come in and join up, I still think it's pretty generous, but but not unrealistic. So 50-50, we're using the friend's credit. Maybe there's, just as an example, $200, $300 a month in cash flow. They split that $100 a piece, right? Every single month. Okay. Now, remember, we talk about this in the buy and holds class. Right. There are 5 ways to make money in real estate, right? So, and I'm talking long-term real estate, rental real estate. There's 5 ways. We use the acronym IDEAL, IDEAL. The first one is income. That's our cash flow. Right. That's not the only way we're making money on a rental. Right. The second one is deductions, right? There's a lot of tax that rental real estate is like the biggest tax shelter there is. The third one is equity, right? So as that house appreciates, your son's entitled to 50%, the other partner's entitled to 50% of whatever that appreciates. So they buy it now for 140, maybe in 10 years when they decide to sell, it'll be worth 250, right? So that means that they're splitting $110,000 2 ways. That's pretty awesome. Okay. Right. So equity appreciation.
Right.
I just gave you the definition for appreciation. Sorry. Equity, paying down that mortgage over time. Right. So in 10 years, we're going to have a lot lower debt than what we started with. That's going to free up room. So when we sell it, that equity we recapture in the form of cash. Then appreciation is, the house may be worth in 10 years, maybe worth 110,000 more. We split that. And then the last thing is L, leverage. potentially we could tap into that appreciation in equity rather than selling the property. Let's just go refinance the mortgage or get a HELOC on it, take that capital and go buy another one. Now we're partners on another property as well. Right. So now we've doubled our portfolio. So, you know, all those things to keep in mind. I think, you know, where it's a long-term, probably I'd say that's an okay structure. Just make sure that you use attorneys and contracts, because contracts keep friends friends.
Right. And that's what I told them. I said, you got to get a contract. Now, they did talk about as soon as they get a couple more houses, they would want me to set it up more like on a property management basis and then pay me, you know, whatever the going rate is. And I said, well, the going rate out here is kind of high. It's like 10%. And they're like, you know, well, just whatever you think is fair. So I will make something, but like I said, it's, you know, he's my son. So if I need something, he will buy it for me. So I'm not too concerned.
Fair enough. You carry his credit card in your pocket.
Oh yeah, absolutely. Oh, and his ATM card.
Nice. Yes. Well, in that case, yeah, good deal.
Yeah.
No, just make sure you're protecting yourself, right? You're not doing this as a charity, obviously.
No.
He is your son, you love him, but at the same time, he needs to understand that if anybody else were in your shoes, they'd be charging him. So you should be charging, right?
Yeah.
That's the same answer I have for equity partners that come back and they're like, well, can Maylee just list it for, you know, and not take a commission? No, because we'd have to pay an agent anyway, right? So if we're not going to pay Maylee a commission, she's not going to want to list it. And now we have to pay a commission anyway, because we got to go out and hire another agent. So no, we're paying Maylee a commission, right? So there's no family favors. This is business. Just protect yourself.
Okay. Will do.
And bad deals, this is why contracts are important. Bad deals can sever friendships and relationships, and you know.
Now I am concerned about people not having to pay rent because of this COVID thing. I actually have a few friends in Las Vegas right now that haven't paid rent since last year, and one just got evicted a few days ago. So that's a concern, having a house payment and not being able to collect rent because they decide not to.
I've found generally, I've not come across a scenario where the lending forbearances don't match up with the rent forbearances. So for example, if your tenant comes to you and say, hey, you know, I legally can have a forbearance on rent here because of COVID, there's nothing you can do about it, except you can go to your bank and be like, I legally could take a forbearance here because of COVID, right? Then you're not getting paid, but at least you don't have to pay anything. No, property taxes, utilities, those types of things are still, you're going to have to pay, the tenant's still going to have to pay, right? But in most cases, you can take, if they're, you know, trying to pull forbearance on you, you can do that same thing with the mortgage company. I haven't seen, now, I may be, that's a blanket statement. I may be wrong in some specific cases, and I'm definitely open to the feedback if I am. But I have yet to see, I've seen several of these situations with students. I've yet to see one where, you know, that's not the case.
Okay.
Did we lose Coach Dan? I think we lost Coach Dan. Dang it, I was going to ask his opinion on that. Okay, good question, Kathy. I appreciate that. Is that did you want to dive deeper into it, or does that answer the question?
That answers it.
Okay, awesome. Well, guys, let's open it back up. What other questions do you have? We're at the top of the hour. We got about 25 minutes left if we want to take it. If we want to take it, now we can wrap up. You guys are in the driver's seat. So if you got questions, let's get them answered.
Let me ask you something, Mitch.
What's up, Don?
Oh, not much. On the speed banking, I've been doing some checking around, trying to find a banking institution that would give me a credit card with check writing privileges, and I haven't had much luck. And I was wondering, what would be your recommendation? What's the best place to look for this kind of setup?
I like this question. Okay, you gotta change the way you're asking the question. And I'm going to give you a few examples here. So I'm putting the speed banking class in the chat right now. If you guys don't know what Don's talking about, check out the class. It's on the Flippin' Sexy Real Estate Education channel. I just put the link to the entire class in the description, so check it out. Okay, so Don, here's the thing about banks. Few things. Number one, the loan officers, the front lines, the tellers, the loan officers, they're not as trained as you are on these strategies, right? They know less about banking than you do, having watched these classes. So remember that you are an expert coming in and talking to an intermediate, not necessarily a novice. They obviously know something about banking. That's why they have their job. They got their training, right? But they're only trained in the everyday normal stuff that a bank wants their tellers to do. So we sometimes get so used to, saying certain things to each other that we go and say to the bank, and they're like, well, you can't do that. One example, when I first started doing speed banking, I went in and sat down with a teller and a loan officer, and I said, hey, I'd like to get a HELOC on my rental property, or one of my rental properties. And I'm like, you can't do that. You can only do it on primary residence, right? And I went home thinking you couldn't do HELOCs on rental properties. You can't do HELOCs on rental properties, but they've got another identical product that just has a different name called a collateralized business line of credit. Had I said that, they would have been like, yeah, absolutely, we can do that, right? But I didn't know, and they didn't know. So we have to be the educated ones here and go in and ask for the right thing. Usually on an unsecured line of credit, I assume we're talking about like an unsecured line of credit, like a credit card.
Mhm.
Okay.
Yeah.
Nobody, if you walk in and say, I want a checkbook for my credit card, then I'm going to look at you like you're nuts, right? So what I did before I was able to get a HELOC or a collateralized business line of credit, the first way that I started doing speed banking was with a $15,000 credit card from my credit union that I had been with since I was 6. My mom set me up an account, right? So I had this credit card. Similar situation to you. I walked in and said, hey, can I write checks out of this? Because I want to pay my mortgage with it. And this just shot up all sorts of red flags, right? You can't do that. You can't write checks, blah, blah, blah. So after doing some more research, I came back, probably the same teller or the same loan officer that I talked to. I said, okay, can I set up my credit card as overdraft protection to my checking account? And they said, yeah, absolutely, you can do that. So what that means is if, let's say I write a check for $100, but I only have $70 in my checking account, obviously that check would bounce if I didn't have overdraft protection, right? I'm off by $30. But with that credit card in place as my overdraft protection, the $70 would clear out of my checking account and the other 30 would be pulled out of the credit card to cover the balance of that check that I wrote. Now we can use that to our favor in this strategy, right? We can have our line of credit that we're operating out of for speed banking, and we can leave the checking account at 0. That means every time we write a check, it completely clears out of the line of credit. Now, most banks will do that. Some banks won't. Some banks won't put their credit card as the overdraft protection. What I found is that most will. It's just a matter of finding the right bank. So if your bank doesn't do it, if your credit union doesn't do it, ask a different one, because that's going to vary bank to bank.
Yeah,
Does
I
that
ran
make
into
sense,
that.
Don?
Yeah, because a lot of the people that I would talk to, they acted like they didn't even know what I was talking about. And,
Right.
so they started asking me, and I'm trying to explain to them what I want. And it's obviously, they didn't understand. And so they just said, no, we don't do that. So would you want to, I guess you want to find out first if they have that product available that gives you a checking account with a credit card as overdraft protection. Would you
So
go ahead and open up both of those accounts at once, or just do the checking first and then add on the credit
so
card
it's
later?
going to take a little research on your end, right? And what we just did is you've got a situation where you're speaking English and they're speaking Portuguese, right? So we got to figure out how to put what we want to say into Portuguese so that we can articulate it to that person, right? So we're thinking in a different route here of how can I accomplish what I want to accomplish using their jargon and their products, right? So the questions
for them.
Yeah, exactly. We gotta dumb it down to their situation, and their situation is they're used to dealing with everyday bank products, right?
Mhm.
So we got to put this jigsaw puzzle together of, I know what I want to accomplish. Now, how do I fit their products in a way that it accomplishes what I want to accomplish, right? And then we go and ask them about their products, you know, in that language. So the first thing I would do is start having conversations with banks. Say, hey, tell me about my overdraft options. Obviously, every bank has that overdraft, that default overdraft protection, where if you overdraft by a penny or $1 or $10, they charge you a $25 fee. Right? That's the default one. We don't want that one because that's best for the bank. That's not best for us.
Right.
What we want to know is, can I get a credit card with you guys? And if I do, can that credit card be the overdraft protection on my checking account? If the answer is yes, then we're moving in the right directions. Now we want to know about the fees. Are you going to charge me $25 every time it does overdraft? In my case, the credit union that I use, there's no flat fee. It's just, it gets charged the interest rate on the credit card, right? So we want to avoid those flat fees of $2, $10, $25, because if we're only using it for $10 and we got to pay an extra 25, well, that's going to add up really fast, right? So we want to make sure that we're not being hit with those fees. Obviously, they're going to charge interest if you're using that line, if you're using that credit card. That's fine. Interest is fine. We're not worried about interest. What we're worried about is those big one-time fees that they'll slap you with per transaction.
Well, and some of them look at that as a cash advance when you go overdraft and draw that money on your credit line, and that
My bank does. Yeah, my bank looks at it as a cash advance. There's not a upfront fee. There's just a higher interest rate. But you know what? I cycle through so fast because all my cash that's coming in sits on top of that. It pays that off within a few days or a few weeks at most, right? So if I'm looking at a 10% interest rate normally and a 17% interest rate on cash advance, remember those are annual interest rates. So if I'm only holding that cash advance for a week before I cycle it out with my income, I don't care, right? The effect of the strategy is going to pay down my debt so much faster than that extra interest rate will make it accumulate. This is why I say in the class, I'm less concerned about interest rates. I'm more concerned about the dollar amount of interest paid. That's the key, right? Okay. So even if it is a cash advance and there's a slightly higher interest rate, I'm more okay with that than I am with, you know, a $25 fee per transaction.
Okay. All right. Thanks.
Now, the smart thing is always do the math, right? Make sure the math checks out, but yeah, if it checks out, which in most cases I think it would, then you're good to go.
All right. Appreciate it.
Does that answer the question?
Yeah, that's good.
Good. Okay. Awesome. All right, guys. Well, any other questions here? What do we want to dive into today?
I got a little question.
Nelson, my man, how's it going?
How you doing, Mitch?
Good, good. Long time no talk, my friend. It's good to have you on the call.
I always come to hear you guys, but I never talk. Hey, I got a question. Good to have you.
Yeah, what's up?
I know the market is pretty crazy right now. Everybody is overbidding each other. Probably you already talk about this, but I came late, like always, because I'm working. I'm a handyman. But you know, the escalate offers. When you make an escalate offer, it's let's say $1,000 more, but you don't want to compete with people that they want to buy the house, they want to live into it, but they don't care. They want to buy just the house. You know, it's not like a fix and flip or something like that. What we want to do. You will do like an offer. Yes, I will do an escalate for $1,000, but for just cash only offers. Mm-hmm. You will do it like that, or because right now.
So here's the thing. I know where you're going with this, and there's you're not going to really get around those people that want to move into the house, right? Your DIYers. So I'm going to share the class real quick. So this is off-market deals on tap. So there's the class I'm referring to now to answer Nelson's question. So in this class, I talk about this, right? If we're finding deals using the MLS, everybody has access to an agent. right? And most amateur investors, that's the only way they know how to find deals is I wait for my agent to bring me one, right? And so it creates such an incredible amount of competition, even just among investors, let alone the people who are like, just find me a crappy house and I'll move into it and work on it, right? So now we're competing against all these people. And you know what? For those investors like you and me, Nelson, that don't want to move into the house, we want to bring a crew in, it's going to cost us a little bit more than the people who are going to bypass all that labor. The reason we're willing to do that is because the very nature of that decision is going to allow us to do 4, 5, 10 of them at a time, whereas the move-in guy can only do one at a time, right? So we're going to make more money, even though we're spending a little bit more to get it done. However, on a specific deal, those move-in guys will win every time because they can pay more for the house because their cost is going to be less. So the key to resolving that is having multiple sources for leads, especially off-market sources. Maylee and I prefer to use off-market sources over on-market sources because of the headache that competition creates. So one of our favorites right now is pre-foreclosures. We're getting that NOD list every week, and we're calling these people, and we're seeing if they're open to us helping protect their credit and prevent a foreclosure from going on their credit, right? And that's a great lead into a conversation to buying their house. And, instead of having 100 people that are throwing offers at them, they may have only talked to 1 or 2, or maybe even no other investors. We might be the only one that's contacted them. Meth houses, right? Those aren't necessarily houses that are listed. They're just houses that are contaminated with meth. We can get that list down at the county health department or by networking with a meth remediation professional, right? So that gives us an edge. We can go talk to these people who think that they're in, they're in this huge underwater mess with meth contamination in their house. Well, we'll come in and solve their problem just by taking it off their hands, right? So those off-market strategies is what I'd start tapping into so that you can avoid that competition. Because really, Nelson, there's no way around that. You're going to have that kind of competition when you're dealing with on-market leads.
Perfect. Yeah. What we have to say here, we have to get up and get your flow closer, knock the doors, stop looking in the MLS. That's the easy way. Awesome. I understand that. I had that in my minds of a lot of months in my mind. And I say, we have to move our body. We have to get out of the comfort zone. Yeah, I know that. Okay. Thank you.
Absolutely. Yeah, you got it. And Nelson, it doesn't have to be you that does it. Like, I don't like knocking doors, and I maybe knocked like 2 or 3 doors for fun one time with Maylee, but other than that, I've never done it seriously, right? Where I've gone out looking for leads by me personally knocking doors, because I don't like that, and I like to enjoy what I do. So I have other people do it, right? I have, I'll work with wholesalers. I'll pay people to go out and knock doors and find deals for me, find leads for me. We're not paying them absorbent amounts of money, right? We're paying them something that's fair, but also something that's not going to break my bank. So, there's a lot of ways to skin a cat. If there's something that you don't want to do or that you're not good at, and you're not good at, hire someone who is.
Okay. Thank you.
Yeah, you got it, dude. Absolutely. Thanks for the question. Good question. All righty.
I have another question. One
Yeah,
more question.
absolutely.
This is Kathy again.
Hey, Kathy.
Do you ever ask a wholesaler to, how should I say this? I'd like to get a deal, obviously, and this is for my daughter, but she would need to do a loan. So is that a possibility? I mean, she could qualify for a loan and get a place, but I'd like it to have equity when she walks in the door versus, buying something retail right now.
Say the first. Sorry, my internet connection I think got fuzzy because
Could I find a wholesale deal? Do wholesalers allow people to do a loan like that? Because then it's going to take at least 30 days.
So here's the problem with a wholesale. Though with a wholesale, you're not technically buying the house from the wholesaler, you're buying the contract from the wholesaler, which means that all of the terms of the contract are already decided before you get to the table.
Right.
So if they wrote a cash offer, you can't do that deal if you need to get a loan, right? If you wrote you know, if they said, hey, we'll close in 12 days, but you need 30, there's nothing you
Gotcha.
can do because the terms of that contract are already decided. So it's going to be slim pickings. You're going to, you know, finding a wholesale deal that has the terms in place that you need, they're going to be fewer and further between. What I would recommend is find a really good buyer's agent.
Okay.
And I happen to have, you're in, what state are you in?
Fayetteville, North Carolina.
In North Carolina. Yeah. I actually have a few really good buyer's agents in North Carolina, South Carolina, Florida. So, and Georgia. So let's connect offline.
Okay.
I can share some of those with you. In fact, Maylee's the one that has those relationships.
Okay.
Let's find you a really good buyer's agent, and that's going to be, I think, your best source. If you're buying something now, I assumed, maybe you said this, but I'm assuming you're talking about her moving into it, right?
Yes.
Like her
Yes.
her house. Yeah.
Correct.
Buyer's agent is going to be the direction you want to go. That's what that system is set up for.
Okay.
Is you know, the realtor system is for retail buyers, and in this case, your daughter would be a retail buyer. So let's connect offline and let's make that happen. I can get you some good contacts.
Okay. All right.
Good question. I like that. I like that question because it clarified from the last question. The difference that we're looking at here is an investment property versus a home, right? So realtors are set up to help people find homes. They're not set up to help us find investment properties. That's kind of a side weird thing that we ask them to do. And my answer to that is don't do it. If we're investors, let's go find them off market. But in this case, I love the question because it clarifies for retail property, use agents. That's what they're set up for. Okay.
Well, she eventually wants to make it turn it into a rental because this is like, this will be her first starter home. And then she wants to, because it'll already, I mean, because she can, out here, our rents are everywhere. Our rents are at least $200 to $300 a month cash flow.
Cool.
We were sick. We didn't buy the house next door because it sold for 91,000 and it rented out for 900.
Oh, wow.
Within a day.
Yeah, that's awesome.
In a day. Yeah.
That's like $300 in cash flow. That's awesome.
I know. So
especially on that low of purchase price. I mean, $300 in cash flow is nuts for a $91,000 acquisition.
Yeah.
That's awesome.
Yeah.
So this brings up another point. So what I understand is she's moving into it first. She's going to live there for X number of years. And then when she decides to move on, she's going to keep the house and rent it out.
Right. And it won't be, it'll be a year.
During this cycle. So, okay, let's use that year then.
Mm-hmm.
So for the first year that she owns this house, she's living in it. Therefore, it's a liability.
Right.
She is paying more towards the house than she is receiving an income from the house. Right.
Correct.
So the first year, it's a liability. So that makes it a retail purchase. Now,
Right.
when she moves out, moves on, buys another house, rents something different, whatever the case might be, then she's going to put tenants in there. And at this point, it's going to be cash flowing. That house goes from being a liability to an asset overnight. But we didn't acquire it that way. We acquired it with the intention of it first being a liability, which makes it a retail purchase. Mm-hmm. So same answer as before, right? But that's why, is because we're starting out as this being a liability, this being the home, mm-hmm. right? But the nice thing is once she finds it and moves into it and lives in it for a year and then decides to move out, at that point, she's got it going for her because she's already got financing in place. She's already built some equity. She's, right. She's decorated, she's painted it, she's put carpet in it, she's done all the things. So at that point, it makes it really, really easy just to add it to the portfolio, and now it's an asset.
Right. And technically, it's kind of going to be a quasi asset because we've already looked into cargo, what do you call those big train metal crates or whatever? I don't know.
Yeah, containers.
Shipping containers. And they're pretty cheap, actually. They're only like $4,300 or $70 a month to rent. So nice. She wants to use that to put all of her inventory because we just selling on eBay.
Oh, cool.
And you maybe set up part of the house that way, and that way she can do tax deductions for the business and so on. So technically she'll have enough land because out here everybody has land. So plus she wants to grow, do a little garden, sell her stuff on the side, organic stuff.
Sure.
That's kind of the plan.
Okay. So she's running a business out of it, and that's awesome. That also makes it a, could easily turn it into an asset if her cash flow is high enough from the business. However, doesn't change that it's the home,
Right.
right? So
Right.
because it's that home, and that's how it's starting out. My suggestion still is approach it as a retail property, right?
Okay.
And if the business makes it more money, that's awesome. And then as soon as we turn it into a rental, then you got the benefit of having already gone through all the financing and all those hoops. So it makes it really easy just to convert.
Right.
That's cool. That sounds fun.
Yeah, especially
Good
the rates
question.
are like under 3%.
What's that?
The rates are under 3%.
Oh yeah, the rates are nuts right now. Yeah, take advantage of that free money, man. Go get a mortgage on it. Just do it traditionally. That's awesome. Okay, so I got another question from Tucky here. So for a collateralized business, we're back to speed banking. Okay, so for a collateralized line of credit, does the property you collateralize have to be under the name of the business you are trying to get the line of credit for? So yes, the title at the time of applying, you can change it later. Legally, you can. The bank doesn't like it, but you can. But at the time of applying for the loan, the bank will require you, because they can also deny you the loan, right? So you can't go fight them and be like, well, I can have it in whatever name I want. And they're like, well, we can lend to whoever we want, right? So you're going to want to have it. Let's say XYZ Incorporated, right, is who you want that line of credit to be through. Then you have to have that entity in XYZ Incorporated. If you're going to do it personally, Tucky, then you have to have it in your personal name when you apply for that collateralized business line of credit. And then once the line of credit goes out, that very next day, you can record it back into your entity or back into your partnership or whatever the case might be. But yes, most, if not all banks will require the title to be in the name of the applicant. It's a good question. That answer your question, Tuggy? Cool. Okay, well, we're just about there. We probably have time for one more question if anyone wants to shoot, or we can wrap it up. It's up to you guys.
I have a question, Mitch.
All right, Paul, last question of the day. How you doing, man?
Yeah, I'm doing fine. How you doing, Mitch?
I'm doing well. Thanks for asking.
Good. Yeah, it sounded like I was listening last week. It sounds like you got some good stuff going on in the works there. So congratulations.
You did. Yeah, actually, you missed at the beginning of the call. We accepted an offer $30,000 above asking price. So
oh my God.
That real headache of a deal turned into, Wade and I and the other partners are going to split up about 80 grand in profit. So
sweet.
Not bad, right?
No, not bad at all. Not bad at all.
Not a bad day.
Yeah, that's awesome. My question was actually regarding the speed banking type thing.
Yeah.
I'm actually involved in a situation like that where I'm actually doing that using equity of savings that I have. And but the thing is, it's supposed to be set up where I get quarterly payments and that type of thing. And the person that I invested with actually is always late. And I'm just wondering, and they're trying to use the excuse of COVID. Because of COVID, the checks don't. So I don't know. It sounded like a great idea when I first started out, meaning I was investing, and then I get these, residual payments, by, every quarterly. So, but it's a type of thing where it's not turning out so good because I'm wondering, does that sound about right? I mean, I don't. It's kind of a thing where it's always late, and according to the contract, a $50 fee is supposed to be included in it, and it never includes that fee. And so far, out of the 3 months, every month it's been late. So
how's your relationship with this person?
At first, it was good. I mean, I met this person. Actually, I met him in Texas, and it was really good. But for some reason, things kind of took it a 360, and I'm kind of getting disillusioned a little bit because it's not sounding out like it was supposed to, like when I was first introduced to it and all that. It sounded really good. Because they were talking about amortized versus non-amortized, that type of thing, and how I could pay down my house and all this stuff. And actually, it sounded great, but it turned out that this person was actually investing for me and invested in mobile homes and that type of thing. So, and then used the monies that I had loan. It was like a 1.7% loan or something. It was pretty low on home, like a home equity line, like a HELOC kind of thing. But it was monies that are on a savings or that I have in a CD, that kind of thing.
So I've got kind of a multifaceted answer for you. So first off, going back to the mindset class, right?
Yeah.
We have our 5 currencies of the wealthy. First is time, then knowledge, then relationships, then credit, then money, right? Relationships is more important than money. So if this is a relationship that you would like to use in the future, that you feel like there's potentially some other stuff we could be doing together, this guy can potentially make me money on other deals. It's a friend that I don't want to lose. Relationships are always more important than money, right? Yeah. But if you're not feeling that way about the relationship, if you're like, this guy's just screwing me over, then let's go back and say, okay, well then the relationship's not there. This person is not contributing to the relationship currency, so all that's left is money, right? And at that point, so you have a contract, which means he owes you that money. You have records of when the payments were due versus when they were paid.
Well, 25th. The last one's done was due the 25th, and right now, what is it, the 9th? So that'll kind of tell you, and it's still nothing.
But do you have records though? Because that gives you recourse, right? So if you have records of showing, hey, look, the contract says it was due on the 25th of every month, I can show you 25 different examples of where he didn't deposit it until this day, and it says I get a $50 late fee if he does that. If you don't care about this, will ruin the relationship, by the way, but if you don't care about the relationship, then here's your option. Send him an invoice. Every time he misses that extra $50, send him an invoice, right? Probably won't pay it. Reference the contract. It says right here in the contract that you pay me $50 if you miss the day, right?
Yeah.
So send him the invoice. After, a month or 2 goes by and he's not paying those invoices, send the invoices along with the contract to collections.
Okay. Yeah, well, it started from day one. I mean, it's like the first one late, second one late. They're trying to use COVID, and I don't see how that would matter. I mean, they're trying to say how because of COVID that checks aren't getting out. It's and on time and that type of thing. Which I'm wondering if they're in a way kind of blowing smoke kind of thing.
Well, I mean, some people have legitimate excuses, right? I've been late, definitely been late on a few payments here and there, and I like to believe I had legitimate excuses for it, right? Yeah. But if it's straining the relationship and you have evidence and feel like he's just jerking you around and you don't want to deal with it anymore, then that's your recourse, right? You can send him invoices. You're justified by the contract. You can send it to collections. A lot of these collections agencies will just buy your debt. Let's say he owes you $5,000. They'll pay you $3,000 up front for money that you probably weren't going to collect anyway. And then they'll go to try to collect the $5,000 from him. And that's how they make their money. Right. So those are always options as well. So it's just the first decision you have to make is the relationship worth saving? Relationships are always more valuable than money in every case, right? But at this point, if he's actively doing something that's detracting from your relationship, then that's not a good relationship. It's not putting money in that relationship account. It's time to take some recourse, and that's where I would start.
Well, it's like a type of thing where I'd never hear from them. And they're not reaching out like saying, well, I'm sorry about this, it's going to be late. We might be talking about this date and this, but it's like I never hear from the person. I only hear from, say, the person that of the company that the manager of the company, never the person who's kind of the one involved with the actual transaction. Do you see what I'm saying?
Right.
Yeah.
Unfortunately, those, it's your decision to make as to which road you go down. But those, that's how I would weigh that situation is first I look at it and say, is the relationship worth anything? If it's not, go after the money for sure. You have a contract in place that says he owes it to you, go after it.
But it was set up in Texas. That's the only problem.
That's
The
okay.
contract.
Yeah, that's okay.
Okay.
You just have to use you have to use the Texas court system and litigate if you end up litigating, but
Yeah.
collections is not litigation, so you shouldn't have to worry about it.
Okay. All right. I appreciate that, Mitch.
But I will say, I'm not your attorney. Make sure that, if you get into a lot of this legal stuff, consult an
Yeah.
attorney.
Yeah. Well, I'm just thinking because of it's real estate, kind of a
Yeah.
situation type of thing that you would
Sure.
be able to
Absolutely.
give me some insight into kind of what I'm trying to do with that.
Was that helpful?
Yes. Thank you very much, Mitch. I appreciate your
You
time
got
and information on that.
Absolutely. All right, guys. Well, that wraps up the call for today. So we're going to be back here. I'm going to try to figure out how to get these things streaming live on YouTube. I tried it today, ran into some snags. So give me 24 hours. I'll have this thing uploaded onto the Flippin' Sexy Real Estate Education YouTube channel. We've got a whole playlist that you can go back and watch previous Ask Mitch Anything videos. And then we will be back here next week at the same time, same link. So make sure you join us. And we will see you then. I love you all. Thanks for joining us. Stay safe, stay healthy. Have a great night.
Thank
See you guys.